Now, let's say we have two portfolios, A and B. Now, portfolio A used 20%, while portfolio B also used 20%. A was very stable, while B experienced a lot of fluctuations and had high volatility. Now, would you say these two portfolios had equally good performances? Well, absolutely not. Now, that's where the Sharpe ratio comes in. The Sharpe ratio can simply be calculated by dividing the returns by the risk-free rate all over the standard deviation of returns. Where your returns is equal to the profit you've made, risk-free rates like a benchmark that is gotten from risk-free assets. For example, you have your treasury bills, while standard deviation of returns is like the valuation of your profits and the volatility from the past. So basically, the Sharpe ratio simply just tells us how much compensation we're getting for every risk that has been taken in the portfolio. Now, take for instance, a portfolio yields about 25% per annum, when the risk-free rate for that year is about 15%. This automatically means that that portfolio is using extra 10% as opposed to what they would have gotten if they had invested in treasury bills or the risk-free rate for that year, which is 15%. Extra 10% sounds good, right? Yes. Now let's imagine if that portfolio passed through high volatility and huge fluctuations. Do you still think extra 10% is enough compensation for the risk that has been taken as opposed to when you would have just invested in treasury bills and gotten 15% as a risk-free asset? The answer automatically changes. Now, as professionals, we use the Sharpe ratio to evaluate if the compensation we're getting for every risk that has been taken in that portfolio is actually good enough. Because if you're investing in a market that is extremely volatile, money can be lost so easily just by a single mistake.